Right, so if you really want to understand the gold market, you have to get two things. First, the raw, kind of crazy energy of a trading floor. And second, the massive historical forces that have been shaping our entire global economy for like the last 80 years. In this explainer, we're diving into Gregory T. Weldon's book, Gold Trading Boot Camp, which takes us on that exact journey. And we're going to start right where he did, on the trading floor. Yep, we're jumping right in, starting exactly where Weldon did. Deep in the chaos, right in the heart of the financial world, on the floor of the Commodities Exchange Center in New York. Okay, so picture this. It's 1984. A young Gregory Weldon steps onto the exchange floor for the very first time. And it is not the stuffy, button-down world he was expecting. Not even close. It's electric. It's pure mayhem. And right then and there, he just knows this is the place he's supposed to be. So his journey kicks off with a real trial by fire. I mean, he's learning the ropes in one of the most intense, high-stakes places you can possibly imagine, the trading pit. And I mean, look at this. This was not a place for quiet, calm calculation. No way. It was physical. It was almost violent. A wild dance of screaming, flailing arms, and just raw emotion. Weldon himself called it a free-for-all, basically a bunch of psychopaths screaming in a language he couldn't even understand. So how in the world does a 6'10" English lit major with absolutely zero experience land a job in the middle of all this chaos? Well, he sees the pit, and all those competitive instincts from his college basketball days just kick in. He literally tells a floor boss that the trading pit is his new basketball lane, and he's ready to get in there and start throwing some elbows. And believe it or not, they hired him right on the spot. And let me tell you, the learning curve was absolutely brutal. In his very first week, he makes a mistake. He lets a stop order, an instruction to sell at a certain price to cut losses, fall right through the cracks. The cost? Nearly 10 grand to his boss. He gets chewed out, just screamed at in front of the entire exchange. But here's the thing. He doesn't crack under the pressure. And that, paradoxically, earns him their respect. He'd pass the test. But, just being tough isn't enough to make it. Weldon's story is really about evolution. About moving from that raw instinct to a much more sophisticated way of thinking. You can really see that evolution in his career path. It's like a masterclass. First, on the floor, he gets a feel for momentum and flow. Then, at Lehman Brothers, he dives deep into the big picture, macro fundamentals. At More Capital, it's all about mastering risk. And finally, at Commodities Corporation, he gets to put it all together. Every single step added another crucial layer to his expertise. And here is the payoff, big time. In 1992, he spots this fundamental weakness in the British pound. So he uses his technical skills to short it, which basically just means he's betting its value is about to drop. Now, while George Soros was getting all the headlines for breaking the Bank of England, Weldon was right there in the mix, banking an incredible 12% return in just 1 month. That was the moment. That's when he knew his whole approach actually worked. So what's the big lesson from all this? Well, his entire evolution really boils down to this one core idea. You can't just look at the charts, and you can't just read the news headlines. Nope. Real lasting success comes from blending the two, combining the what you see in the technicals with the why you get from the big picture fundamentals. And that, right there, brings us to a huge question. I mean, to really trade these markets effectively, you have to understand the entire system they operate in, right? So, what are those giant historical gears turning behind the scenes? Well, to get that answer, we need to rewind. We're going all the way back to 1944, to a quiet little town in New Hampshire, where, believe it or not, the entire modern financial world as we know it was basically designed. So here's the quick roadmap for this whole story. It starts in 1944 when the Allies create a brand new system. By 1971, that system completely breaks down, and by 1980, the fallout sends gold skyrocketing to historic highs. That's pretty much the arc of our modern money story. Okay, so here's the deal they struck. At the time, the US held something like 2/3 of the world's gold. So 44 other nations all agreed to peg their currencies to the US dollar. And the dollar itself, it was pegged to gold at a fixed rate of $35 an ounce. What that meant was the US dollar was, quite literally, as good as gold. And that gave the United States a massive, incredible advantage. And that huge advantage, it actually has a name. It's called seigniorage. It's basically the profit a country gets to make
just by printing the money that the rest of the world has to use for trade. Think about it. It's like the ultimate financial superpower. And practically overnight, America had it.
But there was a catch, a big one. Almost right away, a problem started to pop up. The US began printing way more dollars than it had gold to back them up. So much so that by 1962, not even 20 years later, the US only had enough gold to cover about 11 cents for every single dollar out there in the world. The promise was already turning into a bluff.
And, a bluff that big can't last forever. The entire system, built on this golden promise, was stretching, and it was about to snap.
Yeah, by the late 60s, it wasn't some big secret. Even the policymakers knew they had a massive problem on their hands. I mean, this quote from an advisor to President Johnson says it all. It's crystal clear. There just wasn't enough gold to keep the whole thing going. And countries, especially France, were starting to call America's bluff, showing up and demanding actual gold for their dollars. Then, on a Sunday night, August 15th, 1971, President Nixon gets on TV and basically changes the world. He announces that the U.S. will no longer exchange dollars for gold, period. It became known as the Nixon Shock, and in that one moment, he cut the dollar's last tie to gold and completely shattered the Bretton Woods system. And the reaction from the market? It was immediate. It was explosive. As soon as gold was freed from that $35 peg, its price just went vertical. It quadrupled in less than 3 years. For the first time in a generation, it was the free market, not governments, that was deciding what gold was actually worth. So, all of this brings us right up to today, because according to Weldon, we are still living in the shadow of that one decision back in 1971. And the global imbalances it created, well, they're now more extreme than they have ever been. Weldon really lays out the realities of this new system we're in. Essentially, we have a world economy that's just swimming in credit, and it's all built around this one central loop. You've got countries like China and Japan making cheap goods for an American consumer who, frankly, has no savings and whose main source of wealth is their house. And in return for all those goods, what do those countries get? They just pile up more and more US dollars that are backed by nothing but faith. It's a really codependent and, you could argue, unstable system. And all of that leads to the final and really provocative question that drives Weldon's entire worldview. This whole incredibly complex system is built on one thing: belief in the US dollar. But what happens when the imbalances just get too big? What happens when that faith finally starts to waver? Will we all look around at the global financial system and suddenly realize that the emperor has no clothes? For a trader like Weldon, understanding this massive, fragile system isn't just about learning history, it's about having the key to see what's coming next.